ครับ
Lower.
Pardon?
Lower.
Lower. Lower. question. Team.
Good evening and good morning, everyone. For those that who log in from UK or who those joining us from Hong Kong, I would like to wish everybody a happy weekend. And on behalf of our Juwai Asia, a member of Juwai IQI, I would like to thank everyone for joining us this evening and this morning for our first UK tax webinar. Okay, and I'm your host today. My name is Mandy Chan, and on behalf of Juwai Asia, for those who celebrate Chinese New Year, Happy Chinese New Year and 恭喜發財. Okay, let's kickstart off today's webinar, and I hope that you will enjoy. Okay, before we start our webinar, just a gentle reminder for those that are who is in our Zoom chat, please mute your mic during our presentations. Should you have any questions, feel free to comment in the chat box, or those watch on the live, you can leave your comment in the message box, and we will try to answer it later towards the end of the presentations. You can join us until the end with our Q&A sessions, so please stay tuned with us. So before we start the webinar, let me introduce our speaker of today's. Okay, it's such an honorable today. We're gonna have 3 speakers from Sovereign Group to share their knowledge and experience on UK tax. Firstly, I would like to introduce Simon Dunstan, Managing Director of Sovereign Trust UK Limited, based in UK. And Simon has experience of more than 30 years, and he's actually expertise in the international private clients tax planning, pension trustees, and market entry industrial as well. And he's currently the Vice President of the Lawyers Societies of the Fellows, is a member of the Institute of Management, and is the founder and chairman of the International Professional Association Limited. And he's also a regular lecturer and speaker at tax planning and financial service conventions around the world. Then we're going to have a second speaker, Stuart Stobie, and he is the director of Sun Corporate and Trustee Service Limited, also based in UK, and he has worked in the trust and federate business industry for over 20 years, and started his career in Hong Kong with Grant Thornton before moving to Sovereign. And he's also a member of STEP, and his experience enabled him to work closely with the clients and the advisor and the best company trust solutions for his clients, be it in the corporate or private. And of course, last but not least, we have Winnie Chuck, Client Relationship Managers of the Sovereign Group as well, and based in Hong Kong. So he joined Hong Kong since 2016, and she has more than 10 years experience in corporate and trust services industrial. She will be our translator today for those who join us from Hong Kong, and she will be summarize the UK's tax law in Cantonese later. Okay, without further ado, let's welcome our first speaker of the day, Simon.
Good morning. Thank you so much, Wendy, and also to Jimmy for hosting this event. The only thing I'll be saying in Chinese or Hong Kong Chinese is Sun Lin Fai Lok, and we do, Stuart and I, celebrate Chinese New Year, and it's always a highlight of our year. So Sun Lin Fai Lok to you all, and thank you for giving up some of your Saturday to listen and attend this this webinar. So Wendy, do you want to go to the first slide, please?
Yep.
Thank you. This is the one. This is what we'll be covering today in about 40-45 minutes, ladies and gentlemen. Winnie will be summarizing some of the slides in Cantonese, so that will be a useful reference to you as well. The slideshow will be presented, or presentation will be presented afterwards by email, and I believe this seminar or webinar is being recorded, and to my surprise is live on Facebook. Good job we're not doing that from Australia. Anyway, so welcome again. The theme is investing in UK property assets by navigating the UK landscape, but delivering case study illustrations, ladies and gentlemen, on the practical focus on purchasing a lifestyle property, that's a property you would live in, a buy-to-let residential portfolio, a property you would not live in, but rented to third parties, and acquiring a commercial property, not a residential property, a different asset class. And the reason I say that so obviously, lifestyle, buy-to-let, commercial, is the tax landscape in the UK, even for non-domiciled persons, is specifically different. I saw a question from Law, I think, or unless that's his abbreviation. So sorry for forgive me for getting your name mispronounced. But yes, thanks for the first question. I will be covering domicile and what comprises of a UK taxpayer in the third slide. Questions are taking place at the end, but if I see anything coming through and they're really easy, I will try and answer them. If they're really difficult, I'll leave that to Stuart and Winnie.
Thank you very
Anyway,
much, Simon.
slide two, please. Wendy. Mandy, sorry. Mandy, sorry about that, Winnie. Again, thank you, Juwai, for the introductions. I wish to qualify what we're going to talk about, and in the text slides it will be brief, and in the illustrations, easy to follow, I will give a bit of detail. Part one, ladies and gentlemen, is relevant to buying a property that you'll enjoy personally. That is a main residence, a second residence, a residence that you may visit if you're not going to be living in the UK. Many of you, fortunately, compared to Stuart and myself, will be non-domiciled of the UK, or even if you come to live in the UK, you'll become non-UK domiciled. And there are two tax systems in the UK, domiciled persons and non-UK domiciled. And it's clearly fortunate that the non-domiciled and the non-UK domiciled persons have distinctive advantages compared to the likes of Stuart and myself. So we'll explore individual ownership and when to use the opportunity of trusts, trusts in Hong Kong or classic offshore trusts in the British Isles elsewhere. Part one. Part two is delivering illustrations and case study examples on how to invest in buy-to-let residential property that you will rent to third parties, not occupy. Trade secret, never buy a property in the UK never buy a property in the UK through a company if the family are going to enjoy it. I'll explain why later. And then there's options to buy buy-to-let property in UK companies, options to buy property in overseas companies, and the dreaded inheritance tax, the worst tax on the planet, using trusts and in combination with overseas companies. Part three is my favorite because, or one of my favorites, because this asset is ever so, or the easiest asset to purchase compared with the tax landscape of residential real estate. And part four, Jimmy and Mandy will be hosting some questions. Next slide, please, Mandy. Thank you. Now, for Law's question, if I'm pronouncing your name correctly, I'll read the only thing I'll read from these slides, and I don't read from slides normally, is why the UK taxation regime, which is harsh for Stuart and myself, UK doms, is so beneficial for persons that are non-UK domiciled, and in particular for Hong Kong persons that may seek to relocate to the UK, or Hong Kong persons that are already in the UK but have lived here for less than 15 years. Well, the practical answer is that you can be resident of lots of countries, Hong Kong, China, and the UK at the same time. No problem, because you may be spending a minimum amount of time in those countries You may be investing in those countries, and unfortunately, you could easily be resident in more than one country. That's not what I'm going to cover. In domicile, in an English domicile courts and the English domicile rules and regulations, you can only have one domicile. And we have to recognize domicile by understanding the background of the property investor. I'm going to pick on Winnie, who is, her country of birth is Hong Kong. Her permanent home at the moment is Hong Kong. Her parents were born in Hong Kong. The nation that she has sustained substantial social and economic ties is Hong Kong. She's resided in Hong Kong for most of her life. And even if she went away, she may come back to Hong Kong. So it's clear that Winnie is a Hong Kong person, Hong Kong domiciled. And if she came to live in the UK, or any of you decide to live in the UK, you have the benefit of being non-UK domiciled, but UK resident. And the benefit of this is that for the first 7 years of your life in the UK, you will be UK resident, yes, paying tax on your UK income, bit like the Hong Kong tax system, source-based taxation. But your overseas income and your overseas gains and your overseas assets are not subject to any UK tax control, which is excellent compared to France, Spain, Australia, and those places. And if you want to continue that status for the first 14, 15 years of your life in the UK, which is actually quite a long time, some of it might even double some of your age, well, not ages, but your life, quite a significant time of your life, you can pay what's called a special tax charge, £30,000, and then it increases to £60,000, so that you can make sure that your overseas income, your overseas wealth, your overseas gains that are not remitted to the UK remains insulated, protected, and not taxable, and not subject to any control. The secret to this as well is that non-domiciled persons can take advantage of trusts, overseas arrangements to invest in the UK and invest in other assets around the world, which again will not be subject to UK tax control. Whereas
So
if
can I just nip on this point, where in terms of can I ask you a question quickly, just to clarify, when you talk about, and it's to clarify, to say that somebody like Winnie Chook, who may be moving to the UK and suddenly decides to stay the whole period of time until she becomes domiciled, if she has got, obviously what you're saying is obviously make sure you tax plan and put your non-UK assets into a trust, for example. If then when they hit, say, the 15 years, do those structures, as the legislation currently stands, fall over? Or, and obviously you keep them under review, but what would be the answer? What would be the situation there?
Very good. So Winnie will enjoy this status, and if any Hong Kong people decide to come to the UK in view of Boris Johnson's policy that welcomes now, and rightly so, Hong Kong citizens with the right to enjoy residency in the UK, rather like our EU friends that spent one day in the UK last year, they have settlement rights, and Hong Kong persons now have settlement rights. So you're all welcome, absolutely. And you have this special permission to come into the UK and reside up to 15 years with this beneficial tax system. However, as Stuart rightly says, you can keep your Hong Kong companies, you can keep your Hong Kong pensions, and they will not be treated for taxation for 15 years. And even if you set up a overseas or even a Hong Kong trust, even if you sustain and go past the 15th year and you decide to stay in the UK for the rest of your lives, you're welcome to, you may or may not, then the assets in those arrangements, especially a trust, is not exposed to adverse reporting not exposed to taxation until you actually take an income out. So these are the non-dom rules, where there's seminars that take place all day on these regulations, but I've just given you the highlights because we're now going on to some property solutions, and that's what you're here for. So non-dom, taking advantage, even if you come to the UK, even if you stay here for less than 15 years, and the structuring that Parliament, UK Parliament has legislated for, enables you to use them after 15 years. Thank you. Next slide, Mandy. And Michelle Tan, yes, absolutely. Non-domiciled status question there applies to all overseas nationals, Malaysians, Chinese, it's everyone, French, Spanish. So it's we don't discriminate in the UK. It is either you're like Stuart and myself, UK domiciled, UK resident, taxed on a worldwide income, or you're from another country and you apply those, that Winnie example to your birth, your parents and that sort of thing, to your respective nationalities. So it applies to everyone across the world, which is a very, very good question. Now, this, back to purchase, back to property, ladies and gentlemen. This is a slide specifically relating to the purchase of property and applies, and the taxation rates applicable once only, thankfully once only, to purchasers of residential real estate, not commercial property, not land for development and trade. It's residential real estate. And you find out what the purchase price of your property is, and then you have the graduated rates of stamp duty, land tax. However, if the purchase is going to be made before the 31st of March and it's less than £500,000, zero tax. And there is a surcharge of 3%, but only on residential property. A reference slide, it's a hard tax. We used to be the most competitive in the world in terms of stamp duty about 10 years ago. And as the purchasers of London and South East property are mainly foreign nationals and foreign companies, HMRC and the Treasury decided to increase taxation to sort of slow down the property industry to a point. I don't agree with it. It's increasing stamp duty is a bad tax, a bad move, but I'm not going to persuade the Treasury to change it. These are the purchase taxes. There's a chance for one-to-one questions later or one-to-one meetings later to address case by case the planning available.
In terms of sorry, I'll just jump in again quickly. When you're investing in from overseas, you're probably talking to, you might be approached by a number of people in terms of how to mitigate your stamp duty tax. Anything to do with tax planning, if it looks like a scheme or a product, we would thoroughly and strongly advise against it. Please bring it to our attention. And if we could bring it up, but just be very wary that there's a lot of people out there saying we can mitigate, reduce your stamp duty. Invariably they're flawed, and so we strongly advise against getting involved in that. Or please at least bring it to our attention so we can cast our eye over it.
But this is only these rates are only applicable to residential real estate. On commercial property, not residential dwellings, the maximum rate is 5%. For development land and for development, it's the same. And if you buy more than one property in the same vicinity or building, there's multiple relief to be claimed, which is not a scheme. Anyway, reference slide for you, and you've got to factor those costs in when buying a property, even with mortgage finance. Next slide, please, Mandy. Right, again, on the text and the detail, I will use this as a reference document, but I'm just going to give you a few highlights. I said, I think on slide 1 or 2, do not buy a property in the UK through a company if the family or closely connected parties are going to enjoy it. And that really means that you're not going to exclusively rent it. Because if a close connected party, a friend, a relative, a son and daughter occupy the property during their first month of education, you've got this nasty tax introduced in 2013, which I like to call the mansion tax, which is ATED, annual tax on envelope dwellings. And this is applicable to companies that buy property but do not rent them out to third parties. And even if the property was valued at £2 million or over, the tax charge is £25,200 a year. But if you're renting your property out and it's residential real estate, this tax doesn't apply. So again, just don't buy property through a company if you're going to enjoy it yourselves, the family, and that sort of thing. In 2015, the government introduced, ironically, a conservative government, introduced capital gains tax for non-residents, including non-resident individuals, non-UK companies. So any person, any Hong Kong person, Hong Kong company, offshore company, foreign company that buys property for a price, they sell it, they sell the property or even sell the shares in the company for a gain. You've got the capital gains tax, and I'll come on to the rates later. It's 28% for individuals. It tends to be 19% for companies. But the elephant in the room in terms of, the elephant in the room, which is rather upsetting, is that inheritance tax now applies to property owners, and not just UK domiciled and UK residents, or not just persons that buy in their own name. And I have to say the inheritance tax is, compared to other countries which are actually reducing inheritance tax, they're eliminating inheritance tax like Portugal did many, many years ago. Inheritance tax in the UK is even, well, much harsher than that of the US. In the US, you have the $11.5 million of allowance before you start paying estate duty. In the UK, it is only £325,000. And anything above that, it's an incredible rate of 40%. And not even the best Hong Kong and Malaysian fund manager can ever return a 40% loss. And this inheritance tax applies to shareholders of UK and Hong Kong and offshore companies, especially if the property is a residential buy-to-let property. So 40% inheritance tax is something that, no, you must not focus on totally, but you must be aware of its existence and how to plan for a long-term investment and have a little bit of focus on the relief and planning that is available, especially to non-UK domiciled persons. So if a person is traditionally going to buy a property in their own name, if it's a husband and wife, buy it jointly. Consider mortgage finance, because mortgage finance, especially in the UK, has never been any cheaper. And it is no problem to get mortgage finance for a non-domiciled person, especially a Hong Kong person, but they don't have to be UK resident or have any DNA based in the UK. You would not get a 95% mortgage, but you'd probably get a 65% mortgage based on the loan to value, and you might get it on an interest only basis. If you're buying in your own name, make a UK will, because that will deal with succession planning. And even for persons under the regular pension age of 55, life insurance is not expensive, and a younger generation certainly not. And life insurance can be used to protect against the worst possible inheritance tax charge, and it's not expensive. So there's some default situations. Next slide, please.
Just before we go on to the next slide, could I just re-emphasize what Simon's saying about realizing as soon as you acquire an asset in the UK in your own name, any asset, you create an estate here. So particularly, obviously, we're concentrating on property here. So you acquire a property here, or as Simon says, through a standalone entity. You therefore need to plan for that. And Simon will touch on the planning, on mitigating that planning. But if you decide, for example, well, it's my value, my asset is actually below the 325,000, therefore I don't need to tax plan for it. Fair enough, but you still need to make sure you get a will in place, because we have, just like similar to Hong Kong, that if you or the owner of that property here passes away without a will, it becomes, there's also basically there's regulations and laws here about who gets what from that estate. It goes to a court and they decide where that asset goes to, who inherits that property, which you during your lifetime, or whoever the owner during their lifetime, maybe didn't want that asset going to that particular person, or they wanted it, spread out amongst family members. So it becomes very messy. It can take after a few years to sort out as well. So please, even if you think, oh, the inheritance tax does not catch me because my assets in the UK are below the allowance of £325,000, you still need to make a will to make sure that the probate runs smoothly. In other words, the process of distributing assets from your estate. Sorry to interrupt there, Simon. Just want to.
Thanks very much, Stuart. No, and a will can take a couple of days, and it's £500 at most. A question from James Nagai, or Nai, forgive my pronunciation. If Winnie did become UK resident, and make sure she becomes UK resident from the 6th of April, that's in probably 6 weeks' time, in the new tax year, Winnie does not become taxed on her worldwide income. She is only taxed on her income in the UK and any income she brings into the UK. She's got, don't forget, she's non-UK domiciled, James. So she can enjoy that status for 15 years. If you become resident of France this year, you're taxed on your worldwide income, no negotiation. If you're resident non-UK domiciled, you're not taxed on your worldwide income and your worldwide gains unless you bring them into the UK. Hopefully that's an answer for you there. Next slide, please, Mandy.
Can I just jump in on Law's question from, I hold a British citizen passport, not being am I a UK resident? UK, it doesn't matter what your part. I lived in Hong Kong for a number of years, for 10 years. I was resident for tax purposes in Hong Kong, despite the fact I was a British passport holder. Therefore, your tax residency in the UK depends on how long you are actually in the UK for. So if you're living in Hong Kong with a British passport and haven't been in the UK at all during this financial year, you are not exposed to the UK tax net. I hope that answers your question. Or again, we're happy to expand on these answers if that's not specific enough.
Next slide, please. And also, Law, if you have a Hong Kong passport, because that's where you were born, but you acquired a UK passport because you spent some time here and went back to Hong Kong, you probably are non-UK domiciled because your domicile of origin was Hong Kong. Just because you get a British passport, which you are entitled to normally after 6 years of residence, does not change your domicile. We are not taxed on our passport like the Americans. No disrespect to our American friends. Right, illustration.
Okay, excuse me. I think there are lots of people are very excited to ask questions, and there are lots of questions that are actually flowing in. But let's answer the Q&A session towards the end. Would that be all right? Otherwise, the webinar probably can never be ended. Thank you very much for your cooperation.
Well, we're in lockdown here, so we're fine. We got plenty of time.
Okay,
that's
thank
a very
you.
good point, Mandy. So yes, let's because we have had about 10 minutes of questions.
Yes.
Thank you.
So yes, keep flowing on all the questions. Okay, we'll answer it one by one after the presentations. Thank you very much.
Thank you. And just comment in if I miss anything, Stuart. Right, this is applicable to a non-domiciled or non-UK domiciled family that wish, or a head of family that wish to purchase residential property to enjoy themselves, possibly 1 to 2 million, if not more. And instead of buying it in their own name and being therefore exposed to that dreadful inheritance tax at 40%, we are looking at using a classic offshore trust, perhaps in the Isle of Man, because that's in the British Isles and the regulation is very strict, and the trustee is very near to where the family resides. It doesn't matter where the trustees are based. So let me walk you through quickly. The settlor, one of the spouses of the family, has found a property through Juwai. The property is of a certain value. It is going to be their main residence, secondary residence, and their secondary residence, or just a property to enjoy when they visit. They've decided to appoint Sovereign Trust as the professional regulated trustees. Sovereign create the Kowloon Trust. We just call it the Kowloon Trust because you can call it anything, normally with the word the and trust, and we take the Kowloon Trust, not Manchester United Trust or anything like that. And then the head of family decides that, yes, they would like himself or herself as beneficiary, wife or husband, children, and others. Usually the beneficiaries are the persons that are going to enjoy the asset, or at least enjoy the proceeds when the asset might be sold. You can still get bank finance, possibly 50%, not too high because it's an alternative arrangement that's going to buy the property. Usually this is for a value of at least $1 million to justify the expense and the sophistication to this. But the benefits, ladies and gentlemen, are on the left-hand corner. Because the person contributing assets to the trust is non-UK domicile, the trustee is non-English, and the proceeds going in to buy the property are not UK located, because they're a Hong Kong family, for example. Doesn't matter if they're Malaysian, South African, or Chinese, same classic situation. No tax charge going in, which wouldn't be the case if you're UK domicile. There's no annual tax charge. That terrible ATED. There's no annual tax charge because a trust is not a company. If one of the members of family or more live in the property for 90 nights a year, they can claim main residence, so no capital gains tax should apply if the property is sold for a gain. God forbid the settlor, head of family, suffers a demise, there's no inheritance tax. And if any of the beneficiaries suffer a demise, no inheritance tax. There is a 10-year charge based on the net value, which is featured in this diagram. One question was, what's the annual cost going to be? It's a very quick question. As we go over to the next slide, Mandy, it's about $5,000 a year. So we don't charge fees based on a person's wealth. We're not wealth managers. We're providing professional trustees. Now, that's moved from part one with lots of questions. This is part two, and the applicability is buy-to-let property, not for occupation by the family. Don't enjoy it. Enjoy the proceeds of rental. You're renting this property to Stuart and myself, for example, or just third parties. You can buy buy-to-let property by non-DOMs and UK DOMs through a UK company. Costs may be a little lower. Professional directors are optional. Non-residents, non-domiciled, you probably use an overseas company. UK residents, certainly UK DOMs, might use a UK company. Net rental income will always be subject to tax because the property is located in the UK. The tax rate on a company is, net rental income is 19, similar to Hong Kong, not too far apart, and similar to Singapore. But UK inheritance tax will still apply on residential property, even if you have a UK company owned by a Hong Kong company and there's 2 Hong Kong persons, non-resident, being the owners. 40% inheritance tax will apply come an untimely demise. So in certain cases, case by case, you would use an overseas company, because overseas company distributing dividends to a trust would not be subject to tax, which they would be if it was a UK company into trust. But if the person investing or the family investing into the buy-to-let investment are non-domiciled of the UK, trusts and pension schemes prevent the asset from being subject to UK inheritance tax. Let's have the next slide, Mandy. We go into double figures onto slide 10. So I'm going to look at this slide upwards. You found an asset to buy. It's going to be a buy-to-let real estate. It could be a building of units. It could be one apartment, one house, but it's going to be exclusively let to third parties. So you don't have that dreadful ATED charge. We recognize that it's going to be owned by, this time, an overseas company. Could be BVI, British Virgin Islands or Isle of Man. That's, we all understand how companies work. That company can optionally get a mortgage, 65% loan to finance, and at least in a company landlord, a corporate landlord situation, rental income can be offset against loan finance. So if the loan interest is going to be 3% and the rental income is going to be gross £1,000 a month or more, hopefully, then you've got the deductibility of loan interest. You get about a 65% loan to finance and possibly an interest only as well. If we left the offshore company owned by Winnie and her partner, for example, inheritance tax will still apply despite Winnie being ever so such a young lady. So inheritance tax applies. But there's a non-DOM or a non-UK DOM person, and they can create a trust to own the Isle of Man company or the offshore company. The head of family sets up the trust. The trustees, like in the last illustration, are sovereign. The beneficiaries are the people that are listed next to the trust. Trust owns company, company buys real estate. Again, on the left-hand side, there's no tax going in because you're non-domiciled. There's no annual tax charge because the property is rented exclusively to third parties. Net rental income after deductibility of mortgage interest is taxed at 19 because the asset is in the UK. It's not such a hardship. If the property is sold, instead of 28% capital gains tax on a gain, it's 19%. And God forbid, if the settlor dies or any one beneficiary dies, there's no inheritance tax, but there's a modest 10-yearly charge. And that's how we would use that sort of arrangement, ladies and gentlemen. Next slide, Mandy, please. Now, this is a favorite of Stuart's and I's, my own, acquiring a commercial property. Acquiring a commercial property. This is a property that may be a hotel, it may be an office block, it may be just an office, a warehouse, something you can't live in. And excuse me for treating you a little bit like students, but the tax rules apply to different types of asset classes: development versus buy-to-let versus main residence versus commercial property. Now here, we would very often for a non-UK resident, and especially a non-domiciled person, we would use an Isle of Man company. Because the property that we're buying, not this little summer house that you're seeing me in, because that's probably not very, it may not be residential, it may not be very valuable. But the property that we're buying is probably already VAT elected, or the vendor is VAT registered. And in the Isle of Man, we can register for VAT in 2 weeks. And when the Isle of Man company buys the building, the warehouse, the office block, the retail outlet, as long as the Isle of Man company is VAT registered, with the vendor being VAT registered, the transaction is subject to 0 VAT. Now, the good news is the stamp duty will be no higher than 5%. Hooray! It's not a bad tax charge for a purchaser. Because the asset is generating rental income, it's going to be subject to 19% corporation tax. If you're getting a 60% buy-to-let mortgage, commercial buy-to-let mortgage, deduction of interest charges, with the interest charges being a little higher than residential real estate, maybe 4 to 6%, will be deductible from rental income. Because it's a commercial property, ladies and gentlemen, there's no that ATED charge, there's no annual charge. There's not even a 10-yearly anniversary charge because it's not residential real estate. And currently, commercial property owners that are non-UK domiciled, that use UK and overseas companies, use overseas companies, are not subject to inheritance tax, although we think that is going to change to fall in line with the residential property see-through provisions. So the shareholders in the diagram possibly should be an overseas trust, and then you eliminate the inheritance tax. Gains from a sale, 19%. And that is an easier purchase to make because the tax landscape is so much more easier to navigate through. Next slide, Mandy, please. I'll leave you this slide, ladies and gentlemen. I'm not going to take you through. On the left-hand side, I'm pointing myself at the left-hand side, there's your asset class, main residence, buy-to-let property, property development, UK commercial property. Try not to mix them, keep them separate. You've got the type of structure to use. Even if you use your own names, as Stuart says, make a UK will, consider life insurance, joint names, and then we will get the asset insured. In the middle column, you've got the tax rates, so non-domiciled, and then the last two columns are UK domiciled. So that's a grid for UK domiciled and non-UK domiciled persons. We're going to take some questions in a minute, but now Winnie, you're going to provide a useful summary in Cantonese. Next slide, please.
Okay. Hello， 大家好。Thank you Simon 同埋 Stuart 同我哋傾咗咁多資料性嘅資料，希望大家都仲係 still awake 嚇。咁我做一個簡單嘅總結啦。咁我係 Winnie 啦，我係 base in 香港嘅 Sovereign Trust 嘅。咁第一部分啦，我哋都講咗，其實嚟購買物業，即係我哋自己 enjoy 同埋我哋居住嘅。其實第一樣嘢就係咩係 domicile。頭先Simon 都講過，就係話邊個一個地方居住嘅父母出生㗎啦，佢哋係同嗰個國家其實係好多聯繫嘅。佢嘅子女教育會喺邊一個國家啦，佢哋亦都係打算知道喺嗰個國家嗰度居住嘅。咁呢個咧就叫做 domicile 啦。咁頭先都講過啦 ，Simon 同 Stuart 就會好明顯就係一個UK domicile 嘅人。咁而我咧係即係雖然我喺香港啦，我去出邊讀書，但係翻咗嚟香港 ，most of the time 我哋都喺香港嘅。咁我絕對係一個non-domicile 嘅人啦。咁而稅制頭先講過啦，就係話同非 domicile 同埋 domicile 嘅人咧，佢嘅投資者咧，佢嘅 tax rules 咧，成日都會變更嘅。咁所以我哋基本上都要去捉緊嗰啲 tax rules， 我哋要 get update 啦。咁個人持有頭先都講過啦，個人持有同埋海外信託啦，基本上咧都係有好多唔同嘅選擇。咁頭先喺嗰個 chart 入邊咧都講得好清楚啦。Mandy 唔該。 咁第二部分啦，我哋香港人都係中意做投資properties 啦。咁 properties 嘅話，頭先已經講咗話，盡量我哋唔好用英國公司啦。咁我哋用海外公司去投資會比較好啦，因為我哋基本上要好留意嗰個 IHT 嗰個英國嗰個遺產稅嗰個40% 嗰個 liabilities。咁我哋需要係去注意一下嘅。咁同埋我哋基本上係用咗離岸嘅信託啦，同埋公司嘅結構。頭先喺嗰個Chart 2嗰度咧已經解釋咗究竟點樣係可以令到佢嗰個喺佢個稅方面咧係有更多嘅優惠啦。OK， 咁 OK 唔該 Mandy。咁第三部分啦，好快咁頭先話英國個商業個地產啦，嗰個投資嘅情況就係話其實係比較簡單嘅。咁如果我哋選擇到一個適合嘅 structure 係去用嚟做 hold 住呢個嘅英國商業地產咧，就會成件事咧係好多 benefits 咧喺頭先個 chart 入邊咧亦都解釋清楚㗎啦。咁頭先有一個 point 啦，咁阿 Simon 都講過啦，就係話投資者如果係用一個個人名義嘅話咧，佢哋本身去做 mortgage 啦，佢嘅同時其實要考慮其實需唔需要用一啲結構性嘅工具，包括係即係人壽保險單啦，或者係一啲UK 嘅遺囑咁樣。咁因為咧呢個你都係咧係針對咗嗰個英國嗰個遺產稅嗰個責任嘅。咁 Sovereign 咧其實係可以同大家去再多get 多啲資料啦，希望可以解決一啲方案，係等你哋明白可能多少少嘅。Mandy 唔該。可能簡單啲介紹一下啦。咁 Sovereign Trust Services 啦，咁我哋咧喺1987年咧已經成立啦。咁主要咧都係有3個範疇啦，有做corporate services 啦，企業嘅服務啦，私人嘅服務 private clients 嘅，同埋有啲 pension retirement planning。咁企業服務啦，包括我哋嘅公司嘅成立啦，會計啊，payroll 啊，做發工資啦。咁而嗰個sovereign 嘅我哋嘅private client 咧，我哋都係專去做一啲嘅 family trust 嘅，做啲 trust 為主嘅。咁1987年成立而家都33年歷史㗎啦。咁香港主要係我哋嘅 headquarters 啦。咁我哋香港嘅 office 咧喺 Kinetic Centre 喺荷里活道嘅。咁我哋都希望可以見到大家，希望係可以大家傾下大家嘅方向啊，睇下有冇我哋可以幫到手。咁如果想了解多啲我哋嘅 service 咧，我哋可以睇翻我哋嘅 website 啦，sovereigngroup.com。咁都方便大家去了解多啲資料嘅。Mandy 唔該。咁我哋頭先話我哋嘅係 global wise 嘅，咁我哋有全球有23個 office 啦。咁呢度咧就係我哋嘅辦公室嘅地方啦。咁香港啦，新加坡啦，咁中國我哋有北京同埋上海啦。咁你都睇到一啲新興嘅國家，譬如杜拜啊，UK 我哋都有啦 ，Portugal 啦 ，IOM 啦，呢啲都係我哋嘅office 嘅同事係幫手嘅。咁唔係同其他 partners 嘅，都係我哋自己嘅同事嚟嘅。咁所以有咩嘅 structure 係可以去結構去做嘅時候咧，我哋全部我哋嘅 team 咧都可以直接去 support 嘅，因為 Trustee 咧係需要 license 嘅。OK，Mandy 唔該。咁頭先有幾個重點咧，我都想再講翻啦。咁我諗我哋最緊要係了解咗嗰個即係稅嘅嗰個法規啦，我哋有足夠嘅時間計劃啦，預咗啲 budget 啦，點樣去 structure 我哋嘅 plan 啦。咁因為 set up trust 啊同埋公司咧，其實頭先嘅結構咧都需要一啲時間嘅。咁究竟你哋需要係點樣做法啦？咁我哋預計翻啲時間啦。最重要一樣嘢就係一個可靠嘅partner，係一個夥伴，係可以幫到你哋手嘅。Mandy 唔該。Simon.
Okay, thank you so much, Winnie. I wish I could speak as fast as that. Wonderful. Keeping us to almost time. And I was just to compliment Winnie. I do understand a couple of words of Chinese. We are now into our 4th decade as an independent global group, 34 plus years. Ironically, we've been in Hong Kong with a fully manned active presence for more than 30 years. In Shanghai and Beijing for 10 years, and more than 20 years in Singapore. So clearly we recognize, with Hong Kong being our sister headquarters, we recognize the importance of Southeast Asia and how we have grown globally from the humble days where we were based 30 plus years ago. Now 475 management and staff, independently owned though, not listed on a stock exchange, not owned by a private equity group. We have been independently owned, and our chairman still an English barrister still resides in Hong Kong, and it's fair to say that we have been, we are regulated, which is not difficult to acquire, regulated in a dozen or more financial centres, including Hong Kong, as a professional trustee and a corporate service provider, complementing Winnie there. So that's where we are demonstrating our important sister headquarters in Hong Kong, where Winnie and her team are based.
Can I just add in if anybody's looking at where I am, the Wirral is just, if you don't know UK that well, it's adjacent to Liverpool. So we're up on Merseyside. So again, I know that a lot of money has been invested from Hong Kong into places like Manchester and Liverpool. We're on the doorstep of those two cities, and therefore have knowledge and expertise when it comes to people looking to invest there. So please, also you can tap that up as well. But I thought to say that I'm actually in the north. I'm actually sitting in North Wales right now. But we're in that's where the Wirral office is as well.
But still very much part of Team UK and Team London. And I'm in the Charing Cross Strand, not too far from one of my favourite districts, Chinatown, of course. And Michelle Tan, if we're going now to Mandy, can we go to questions, please?
Yep.
Yeah.
Okay. One question from Michelle Tan: do we deliver on mortgages? Well, no, we're not specifically licensed to undertake that, but we have qualified associates that are expert at delivering mortgages, which tend to be called specialized finance, because the borrower may not be UK domiciled, and more importantly, they may not be UK resident. So there is an application for Stuart and I, because we're UK resident, UK domiciled, we perhaps have a salary and have a footprint in the UK, and a bit of DNA. But those that are non-domiciled and non-resident, we have 4 or 5 or half a dozen mortgage partners that can deliver buy-to-let finance, 65% loan to value, main residence if it's really a large valuable property, 50%, 60% on commercial real estate. There's bridging loans for buying in an auction and then refinancing after when the value of the property goes up especially. So yes, we have associates that deliver on mortgage finance, regardless of nationality, regardless of type of company that is used, or your domicile, citizenship, and that sort of thing. So hopefully that's answered the question. There was a very interesting question from, I forget the person, Mandy, about is my Hong Kong pension income subject to UK tax if I relocated to the UK? Well, the answer to that, from a jumping off the fence, and neither is it my style or Stuart's to stay on the fence. If you come to the UK and you're still entitled to a Hong Kong pension because you've gone past perhaps a certain age, then as long as the pension income is non-UK, which you said it is because it's a Hong Kong pension, as long as the Hong Kong pension is paid to your Hong Kong or overseas bank account, no UK tax. But if that income is subsequently, if the pension is subsequently remitted into the UK, then remittances of overseas income to the UK is subject to tax. But if you don't remit it to the UK, then there shouldn't be any tax, and that applies for at least the first 7 years and can be extended to 15 years. And in any case, if you become UK resident and a normal taxpayer, your first £12,500 is not subject to tax. So as long as you don't remit it, I think it was a sir that asked the question, then that is the tax rate. And you go back to my third slide, the nice red slide about domicile, the 0 to 7, 8 to 12, 12 to 15. There was a question, forgive me, I forget the name because it was, and one more.
Okay, Simon, let me read out the questions for you.
Yes, sorry, Mandy.
Okay, so there's one question was actually asking, will buying property in a limited company reduce IHT exposure?
If you buy it through a overseas company, you have some tax advantages plus limited liability, and also from a corporation point of view, if you get a mortgage, you will get full deductibility, but you will not benefit from inheritance tax planning unless the shares of the overseas company is held in a trust. So you've got to think that setting up a company like it used to be 10 years ago, companies never die, people do, that's okay. Well, it's not okay if you die, but if the company never dies, no inheritance tax. Then the laws were changed. So if the individuals, if the persons owning the shares in the overseas company, inheritance tax will still apply. But if the shares are owned by a trust, then you eliminate the inheritance tax. So think of the two-tier combination: trust and company buying buy-to-let real estate, or a trust to buy the main residence, that the lifestyle property, no inheritance tax. And if you're buying commercial property owned through a company, you have no inheritance tax yet, although I would always use an Isle of Man company to be owned by a trust for a non-dom, and an Isle of Man company owned by a pension for a UK dom. Case by case, Mandy, but hopefully on a case by case basis, we can give the practical answers and the clearance and clarification that your delegates deserve.
Okay, thank you very much. Okay, another question is there any types of tax exemptions, for example, disability or anything else?
I mean, there are tax exemptions in the UK around, and also you do get some breaks when it comes to disabilities, but unfortunately, it does not apply. It basically will not apply here on when we're talking about overall property investments. Unfortunately, we'll have to caveat this. I'm not an expert on taxations and taxation exemptions applied to the disabled, but our understanding, for the most part, depending if you're disabled or not, there'll be no exemptions available in regard to the taxes we're talking about.
Yeah. All right. So another question is, what are the criteria for being legally classified as UK resident?
Right. The UK resident is based on, is not just on day counting. A UK resident is normally resident for tax purposes if he or she lives in the UK for 6 months or more than 6 months in any one tax year. So that's the norm, which is the norm in many many cases. But then if you come to work in the UK and this is your main vital interest, you're UK resident, and if you tend to stay in the UK more days than any other country, then you're UK resident. And there's what's called a statutory residence test, which is quite harsh, but at least it's now clearer, and we no longer have to rely on a tax court case that took place 150 years ago. And it used to be like that, president law. So the statute residence test will determine the number of ties that you have. Have you come here with your family? That means children and a spouse. Have you, do you work here for more than 40 days? And that's another connection. Have you got a property available for your use? And are you here longer in this country than you are the last country? Normally for work, if you're working here for more than 30 hours a week and more than 40 days a year, you're resident. If you're here for more than 6 months a year, obviously you're resident. And if you've got some connections, it's very easy to become resident, and it's more difficult to leave, and therefore more difficult for Stuart and I to leave if we don't do it properly. Case by case, we'll give you specific tax advice with the first hour or the first meeting, complete without obligation, because we've got to study, we've got to evaluate your situation, and the first meeting, the first consultation, complete without obligation. And as you're a friend or a client or an associate of Juwai, that extends to all of you. Okay.
Okay, thank you very much. Okay, another question, is there much difference owning properties in BVI or Smart UK SPV Limited? So the share of the company to give to the family, is there any difference?
Not really. If the shares of the BVI or the UK company are directly owned by individual members of family, then you're still going to have application to the inheritance tax, because the inheritance tax cannot be relieved if it was made through a trust. A UK company is going to be less expensive than perhaps a BVI company, and the UK company could easily be controlled by a UK resident director. A BVI company would normally have offshore directors. So if it was a buy-to-let residential property and you are not using a trust, and maybe coming to the UK as well, I'd use a UK company. It'd be less expensive. And it's actually, yes, got the answer. If you want to get mortgage finance, compared with trying to get mortgage finance for a BVI company would be easier through a UK company. But to the question person, case by case, we'll evaluate your situation on a case by case.
Yeah.
If you use a BVI company, it's very easy to put those shares in a trust. If it's a UK company, you wouldn't put the shares in a trust.
All right.
Yeah, and I think just to add to that as well is obviously running a people over in Hong Kong, obviously BVI is sort of as regularly used, and they're very simple to administer, whereas a UK company is more complex. So where you may be cheaper in terms of setting up the UK company, the actual running costs of a UK company are probably, due to all the compliance that has to go on over here, is far more excessive than what you'd have with a BVI company. So in terms of the tax planning, there's probably not much difference, but I would still always push at having an offshore company, because why get yourself tied up in the UK legal and company system if you can still do the same thing through offshore? That means if there's any changes to legislation in the UK and you think, right, I want to effectively get out, it's much easier to do that through an offshore structure than having a fully blown UK company here. So I'd always guide you. But again, as Simon says, it's case by case.
You would. The only exception to that, Stuart, and you're absolutely right, is you would probably get a more preferential mortgage rate if you used a UK company. But again, as Stuart said, it's case by case. Mandy.
All right. So there's another question from Law. If I'm going to use the buy-to-let mode, how would the UK government charge me on the tax? And furthermore, what is the process of charging the tax? Will the management agents help the UK government to keep up some portions of my rent as a tax?
Right.
Is he, sorry, it was a question, is he, sorry, if he's buying, so this is Law again. If you're buying that property in your own name, Law, then you are the taxpayer. So you're the one who is responsible for paying those taxes. Some management companies will retain the requisite amount of taxes and will offer that service and pay. There are schemes to do that, but you ultimately are liable for paying that tax. And so you make the emphasis on you to make sure that everything is settled. And again, this is where a company like ourselves can step in and ensure that there's full compliance with your tax, all the tax you have to file.
On that, Stuart, on whether Law buys in his own name or through a company, the person or the company buying must be registered with HMRC. Now that's not negative. It means that your rental income can be paid gross, because if you're not registered with HMRC, the rental agent will withhold the rent or some of the rent for the payment of the tax. So we get you registered with HMRC. So if it's Winnie buying, she gets registered with HMRC. If it's Winnie Limited buying, Winnie Limited gets registered with HMRC, whether it's a UK or an overseas company, so that the agent renting the property or Juwai renting the property or their partner will pay the income gross minus their costs, of course. And then at the end of the year, you would, or we would, calculate the net rental income. You would deduct the mortgage charge if you were a UK or offshore company. However, persons, private landlords, are only able to deduct 20% of the mortgage finance. So clearly HMRC prefer corporate landlords rather than private landlords. And then on the net balance, individuals pay 20% tax generally, and companies pay 19% tax. Individuals do not enjoy limited liability, companies do, and overseas companies have the possibility of putting their shares into trust to be relieved from UK inheritance tax. So that answers that from Stuart and myself. Mandy.
Okay, great. So another question is like, please mention about the setup cost and the running cost of an overseas trust.
Okay, now overseas trust to buy the family property that will be enjoyed by mum, dad, children, and others. And this is for a property, you know, £2 to £3 million, for example, just started at that. The setup fees, and it's a rough fee because I'm not going to give you an itemized fee schedule. We don't have enough time. But the setup fees, the setup fees, getting a bank account open because we have to insure the property, and pay some obligations, which would be no different to that made in a UK in a normal physical person. In the first year, it is likely to be £5,500 because you've got all the setup fees and the compliance. And then annually thereafter, it would be about £3,000. Case by case, but you've got those sorts. It's never going to be a percentage of the value of the property. We're not asset managers. We're not IFAs. No disrespect to those. They provide a different service because they're generating wealth for your movable assets. Regardless of the value of the asset, the tax saved, who you are, Hong Kong domiciled or UK domiciled, we are very reasonable, competitive, and transparent. Okay, next question.
Okay, great. Okay, that's the questions. I guess it's the last two questions. If I'm a Hong Kong resident and will not live in UK, in order to save the tax, is it sufficient for me just to use the company to hold the UK property, or should I use the trust instead?
If he's going to be staying in Hong Kong, but obviously, but owning the property, obviously the best thing, the first step always in terms of is to look at that asset that you're acquiring in the UK, and you're creating, by doing so, you're creating an estate in the UK, and therefore upon your demise, you would be subject to inheritance tax. So so you would need to have to mitigate the inheritance tax. You would need to have a trust established to mitigate it against any IHT in the UK.
All right. So how much is the asset should start the BVI trust approach?
If to answer, I think there was another question. Similar to on costs. We talked about the trust cost, but if you've got a trust and company combination, because the company is going to own the buy-to-let residential portfolio, I think with the overseas company with the statutory services the fiscal, the remail, the accounts, the directors, and again, we got itemized transparent fees. It's about £5,000 per year. So to justify those fees, the buy-to-let portfolio should possibly be at least £1 million, and the main residence for the trust should be £1 million plus, especially if it's a standalone property for the family, £1 million plus. Buy-to-let portfolio for the trust and company at least £1 million. So therefore, you've got some indicative costs there. There's no point saying it starts from and you'll end up finishing at. I'm giving you the end case scenario, transparent fixed fees, never dependent on the value of assets or one's circumstances. So the property has to have a justifiable value to enjoy these benefits.
Mandy, also, I don't think I answered Patrickson's question in full. Patrick, apologies for that. Yes, basically, your company, it is more efficient, tax efficient to own a property through a company in the UK rather than yourself. So yes, so that would be sufficient, ignoring IHT, to mitigate against or reduce your UK tax exposure. Sorry, I should have answered that more comprehensively.
Yeah. So I know this conversation shouldn't dominate inheritance tax, because the family composition may be a lot different to family compositions in the UK. Hong Kong investors tend to be a bit younger than those that are traditionally UK. The family situation may be different. The length of time that one tends to hold a property may be different. So we're not trying to give you an IHT, an inheritance tax lecture, but if you wanted to have the security of not being subject to inheritance tax, enjoying the flexibility, enjoying the privacy, enjoying the succession that individuals do not naturally have, then the trust and the overseas company for a buy-to-let, the trust to buy the main residence and the overseas company to buy the commercial property are the best ways to go. But we'll deliver an example on a case-by-case basis.
All right, so I guess that will be the last questions of the sessions from Emily. Will your company provide standalone tax planning service if there's no trust facilities needed?
Yeah, as I said, if the default option is to buy in one's own name, then we would make sure that don't forget to insure your property. There may be mortgage opportunities because you can demonstrate that you can easily repay the finance, and using debt. Inheritance tax is only payable on the net value of the property. So if there's debt to pay or debt outstanding, mortgage finance can be quite useful, especially for slightly younger generations. Please don't forget the will, the last will. It's a UK asset. Your Hong Kong will probably should cover it, but it's not a problem to get a UK will. You don't need a notary. You don't need 10 law firms to look at it. It's an easy process, and it's only going to cost £500. Okay, it's £500, but you may thank yourself and us for doing it, because once it's there, it is totally reliable. And even if you buy in your own names, because that may be relevant for a first purchase, or you have already bought in your own names and you may look to do something else in the future. For persons less than 55 years of age, and even those that have slightly younger spouses, then life insurance is not at all expensive. And just because you've got citizenship of a non-UK origin and you don't live here, we specialize in getting life insurance. So the life insurance is paid not on the first spouse dying, but on the surviving spouse dying, the second spouse, or the survivor. I think that's the technical term. So life insurance is not expensive, which will be used to pay for the worst case inheritance tax. So those practical considerations will always be evaluated when a property investment or any asset is acquired in the UK, regardless of one's situation. And it's not just property we deal with, it's companies trading internationally, movable assets, immovable assets, our 23 offices and our services that we've provided for the last 34 years covers major more asset situations. But because this is a Juwai delivered conference purely on UK property, and there is a desire for Hong Kong persons to, and the rest of the region, to invest in UK property, it's particularly useful and a useful asset class to hold, providing you do it carefully, skillfully, and with the services that we can provide. And friends and clients and associates with Juwai will always get an informed consultation, because we need you to share the information with us, and completely without obligation, ladies and gentlemen. Okay.
All right. Thanks a lot very much for such an insightful sharing, and especially to Simon, Stuart, and Vinny. I believe that with today's sessions, a lot of us has actually benefit a lot in terms of the investment, tax planning, or will, or trust as well. So on behalf of Juwai.AsiaHK, a member of Juwai.IQI, I would like to thank again everyone for your participations, and as well as our honorary speakers for such a great sharing. So feel free to contact us if you need more information, or if you have further inquiry. Remember, you can always drop us a note, or still leave your comment in the comment box. We will try to get back to you and answer all your questions accordingly. Of course, we do provide one-to-one service as well. So in the events that you need further inquiry, just contact one of our sales consultants, or you leave your comment box in the comment box. We would try to get someone to contact you as soon as possible. So again, thank you very much. I hope everybody have a great weekend. Take care and stay safe. My name is Mandy here, signing off. Bye-bye.
Bye-bye. Thanks, guys.
Bye. Thank you, everybody. Thank you.
Cheers
Thank you for
now.
your time. Have a good weekend. Bye-bye.
Yes, bye-bye.
Bye-bye.
Thanks, guys. Bye now.
Thank you. Mandy, we reconnect on Monday or next week, yeah?
Yep.
Cool. Thanks, Mandy, so much for your help.
Yeah.
Thanks, Mandy.
Thank
Yep.
you, Stuart.
Thanks,
See you
Jimmy.
later.
Thanks, Jimmy. Thanks, Simon. Bye,
Have a
Stuart.
nice evening.
Cheers. Cheers, Winnie. Have a good evening.
Yeah, cheers.
Thank you.
Bye.
So we will wrap up all the questions in the events that we miss any. I will actually feedback to you again.